Good day, fellow investors. The new GMO 7-year asset class real return forecast is out, and it has never been uglier than this for US stocks. Average -6% projected real return going forward, which then leads to a 7-year real return of -40% for US stocks. If we go internationally, still not of a great return international, a little bit better than others is with emerging value, but keep in mind, even emerging value is delivering a smaller return than what is the historical US equity return of 6.5% real, few percentage point of inflation, and then you come to the stocks do return 10% per year. So practically no assets in the current environment will return, according to GMO, what US stocks have been returning since the last century and a half. Now, when it comes to such negativity, let's just discuss the reason and also the rationale behind that and whether it will happen or not. It might not happen. The thing is that the real returns go lower because stock prices go higher, and consequently it's mathematics, the risk goes up and the returns go down. That's pure mathematics, but also stocks go higher and valuations go higher. So the stock market is not expanding thanks to great earnings. Yes, things are good, but valuations are expanding even faster, and that's why we now have a price earnings ratio of 38 for the Shiller P ratio that uses 10-year average earnings, and you can see it going up from 15 in 2009 to 38. From an average of historical 15, we are now 2x, more than 2x historical averages, and you can see these long-term cycles of exuberance followed by capitulation, exuberance, capitulation, exuberance, capitulation, exuberance, capitulation, and we are now again in a cycle of exuberance. Of course, GMO cannot know whether this cycle of exuberance will continue, and a comment that there is often here on YouTube is that GMO has been wrong for almost a decade now. So if you looked at the GMO from 2019, this was -2%, and then one would say, okay, I'm not going to invest in US stocks because of negative real returns going forward. Fast forward 7 years and the stock market is up 100% versus GMO's negative prediction. But they are looking at the fundamentals, they are looking at what drives market expansion and the risk and reward based on the historical, let's say, situation. Each time we have had these valuation expansions, well, it again retracted each time, and therefore all the valuation gains sooner or later revert to the mean, and you don't make much on valuations. Of course, this time can be different and valuations can remain higher forever, but if we just give back the valuation gain from the last few years, 2x, then stocks would go back to 3,000, which is then a 50% decrease, 40% in real terms, and if earnings go up a little bit over the next 7 years, there you have your return. So this is GMO's projection. They are looking at what has happened in history with valuations, and they are estimating that, let's say, most likely historically the returns will be negative. However, it is impossible to know whether valuations will continue to rise for the next 7 years, and then GMO might again be wrong. Now, when it comes to investing, there is what we can and what we cannot know, and therefore we have to compare that to the risk and reward we want to take when we want to put our money somewhere. So if valuations expand, then valuations might also contract, and then you see the value of your dollar go down. But that can always happen. However, the question is, where will valuations be in 2030? And the truth is that we cannot know that. Maybe valuations will be at 20, maybe at 10, if we have a situation like this or like this or like this. Maybe those can even go higher for a few years if, let's say, the bubble environment continues. So that's something we cannot know when it comes to valuations. Let's discuss earnings. Can we know where will earnings be in 2030? That's already something easier. If I look at earnings over the last 24, 25 years, on average, earnings grew a little bit slower than just shy of 3%. But if that continues, on average, recessions, this and that, we are at 245 when it comes to S&P 500 earnings in 7 years. And despite the growth in earnings, that would still give a P ratio of 24 on the current situation. And that would contract the current P ratio, but 30, 24, still very far away from historical averages, and that is what GMO says also about the market and how it is risky. But with earnings, you can already know a little bit more. You can estimate a little bit easier that businesses will grow, inflation will be there, so there will be some growth. Where will stocks be? As we said, we cannot know about valuations, we cannot know about recessions, things like that. So we cannot predict where will stocks be, but we can know the earnings, and we can look at the earnings and the dividend yield and then think about whether what is going on right now fits us personally. Thus, we also cannot know whether GMO will be right or not finally. We can just wait and see and enjoy their presentations while we build wealth. Because what is the base of building wealth? If you are subscribed to this channel, then you are focused on dividends, earnings, growth, business growth, and the price you are paying for an asset is key. In the current market, stocks only go up, price doesn't matter, and that is then pushing valuations even higher and higher. And it is impossible to predict for how long will that continue, but here we are, and this kind of investing is getting harder and harder, while this is just enjoying seeing the portfolios go up. Me personally, I know that this works over all the cycles, while this doesn't work in the negative parts of the cycle where all these investors get really butchered. And now, what is GMO's answer to all of this? They say that you need to go for quality and value, and that is the answer to the current market overvaluedness or overpricedness. And they go for value, which means that the price to forward earnings is even lower, value that isn't junky. Thus, you go for an opportunistic value, strategy, exposure, characteristics, good cash flows, better than, let's say, the value indexes. We discussed these value indexes, and that is not value from a value investing perspective. So you need a more opportunistic way of doing that. Debt to equity is lower, and also return on equity is higher if you measure quality like that. Then I've looked a little bit at the holdings of GMO, and then we have JPM, Facebook, Exxon, J&J, Bank of America, Chevron, Merck, Cisco, IBM. Now, is this junky? This is Goldman Sachs, banks. I would say this is cheaper than the market for perhaps the same things. But if you ask me personally, if the market drops 50% and I owe these things and I drop 30%, that's not something I would be happy with. So GMO, they have a lot of funds, a lot of ETFs and everything, and their focus is to outperform the market, or at least try to do that. But I don't care about outperforming the market if the market drops 50%. I'm not happy if I'm down 30% over the long term. Let's say if valuations just retract. So this will likely do good as a basket, because there are also dividends and things like that, but it can still suffer a lot in a proper downturn. I have looked also at their opportunistic value fund international. I have to look at Total Energies, then we have pharma that I don't do. BHP will look into that. Bank I don't do. Pharma, banks, pharma, bank. So you can see that there are a lot of financials which are, yes, cheap, but financials also carry always a risk. So I don't know whether the market is pricing them right or wrong. As I said, I don't do financials. So we'll see whether this will materialize or not, whether going for value will provide better returns. But I want to perform. I don't care about outperforming. I just want to perform no matter what's the cycle. And that is done by buying businesses where you can find value. So I hope you enjoyed this video. Thanks for it, and I'll see you in the next one.